Can I invite René Cassis to the stage and for his panel to join hard on his heels, please? So I've got a few words while they shuffle up, but I will stop the moment they get all on the stage. René Cassis is the Managing Director, Head of Private Debt for La Banque Postale Asset Management. He's going to be leading a diverse panel on new sectors, actors, and strategies. He's well placed to do that, and he's going to try and knit together, perhaps, well, hopefully, the disparate views at times of a panel including industrial sponsors, debt and equity managers, and a bank. René, over to you.
Thank you. Good afternoon, everybody, and welcome to this panel debate. We are going to talk about infrastructure finance, new sectors, new actors, and new strategies. Before we dive in our discussion, and before I introduce our fellow panelists, I would just like to share a few words with you just to set the background of this discussion. These days we are celebrating the 10-year anniversary of Lehman Brothers. I'm not sure we should call it an anniversary, but it was 10 years ago. And what a journey has it been for infrastructure finance. Really a journey on the roller coasters. From the dark days when we were living in a near-death experience to the very dynamic markets in which we are currently living. A market which has truly reinvented itself through a number of quite exciting developments on so many fronts that we are going to review with our panelists. In terms of sectors, we have moved from the very traditional transportation and PPP sectors, a lot to do with concrete, with steel, with macadam, to these new territories of renewable energy and energy transition. The digital world is becoming part of infrastructure, not only as a sector as such, but it's also transforming the way we can operate infrastructure. So we're going to hear also about smart infrastructure, augmented infrastructure. This is publicity for you, Laurent, and digitalization, very high words, but a real reality at play there. New actors, eminent representatives here. We have seen the traditional industrial sponsors joining forces with equity funds, which are not only bringing capital, but also bringing new ways to deliver and to manage infrastructure quite efficiently. This is on the equity side. Likewise, on the debt side, we have heard minutes ago, François Riahi telling us how the banks have reshaped their business models and the way they are working now with a new breed of investors, institutional investors, debt funds, which are bringing to the market innovative and long-term financing solutions. Last point, it was already discussed, and we will keep on discussing it, the responsible investment agenda, which is becoming a key driver of this market. This is becoming the new reality, the new face of infrastructure finance. And infrastructure finance in the political arena is turning from an issue or a problem to deal with when it comes to budgetary discipline into a solution provider to meet the key challenges of climate change. So for that, to debate all these issues, we have a quite ideal panel with representatives of many of the main stakeholders in this brave new world. So let me now introduce them. Laurent Fayolas, you're Managing Director at Ardian Infrastructure, who on the equity side has been there almost from the beginning, maybe 15 years ago. Klaus Vintzen, you're CIO and Head of Infrastructure Debt at Allianz Global Investors, probably the largest debt investor in this world. I'm putting aside La Banque Postale Asset Management, but I'm keeping it neutral as a moderator here. Then Angelika Schöchlin, Senior Partner at Antin Infrastructure Partners. Antin celebrated a few months ago, your 10-year anniversary. So this year is full of celebrations, but this one is definitely a positive one. And then we have Matthew Norman. Matthew, you're a group head of infrastructure at Crédit Agricole CIB, one of the global players in this market. And last but not least, Philippe Lecagne, you're head of acquisition, investment, and financial advisory at NG. Actually, I'd like to start with you, Philippe. NG is also a global player. You're involved in so many sectors, traditional sectors, if I can put it this way, pipelines, conventional energy, to renewable energy and energy transition. You're also acting and operating across the planet, from Latin America to the Middle East and beyond. And you're constantly on the road looking for capital, looking for financing. So can you please share us your views on the trends and the dynamics that you see currently on this market?
Okay, thank you all. I think my first view on the change since 10 years in the infrastructure is really the cost of capital. What we have seen as NG, as an industrial player, we were almost competing only with industrial players 10 years ago, and today is a cost of capital that is very low. This has led us to change in strategy, mostly on the equity side, because what we see is really the equity return that have decreased a lot over 10 years. And this led us basically to go more and more to infra fund, partnering with them, so that they can bring their added value in terms of financing, but also cost of capital. And we are still there as an industrial player to bring our development and O&M capabilities. On the second hand, what we are seeing is not really a decrease in relative terms of the debt cost, meaning the margin. It's much more the underlying sovereign that has decreased. That being said, long-term financing is less available than before. We have only today on the market, especially in the US dollar, only French and Japanese banks. In euro, a bit more liquidity, but the big trends being investor in many emerging countries we have seen is definitely the emergence of local market. Can it be in the Middle East, where we can tap now liquidity there? Can it be in South America? Or as well in some place of Asia with some Korean banks, for instance.
Matthew, we've just heard from Philippe the interactions between global players, global bankers, and local bankers, and we've heard that liquidity, although we are always hearing that liquidity is everywhere, we're hearing something a little bit different here from Philippe, and can you share with us your views on the market?
I'd like to make 3 points actually on the infrastructure finance market. Firstly, what we've seen over the last few years is a record level of funds raised, both on the equity and debt side. And currently, this year, I think we'll raise close to $70 billion in equity. And next year, if you look at the outlook for next year, probably looking at something around $100 billion mark, all other things being equal. What does that mean? I mean, I think it's positive for governments and corporates, gives them options. They've got options around meeting the structural deficit in infrastructure. I think, on the other hand, that strong level of liquidity there on the equity side is what we've seen is a very, very strong run-up in asset prices over the last 4 or 5 years. What does that mean? What we're seeing is very strong optimism and enthusiasm today and also into the future. Greater risk tolerance, both on the equity and debt side. And what's been driving those asset prices? It's really equity, actually. I mean, I'll come back and talk about debt very, very quickly, but most of the deals today, and that's a big difference where we are today than where we were 10 years ago. Second point I'd like to make, the key driver in the volumes we've seen over the last few years has really been in the non-core segment. So that's, we heard about it earlier, the sort of ferries, midstream, TMT, healthcare. Why has that happened? We've seen traditional GPs in the infrastructure sector effectively priced out of core infrastructure. Who's pricing them out? Direct investors and some of the low-risk managers, traditional PPP investors who've come in and reinvented their strategies. What have we seen there? On the equity side, a greater segmentation and maturity around the market, actually, which is interesting. So not everyone today is playing infrastructure as it was in 2007. In 2007, every asset that was bought was treated as infrastructure and sold to LPs as infrastructure. Today, it's a bit like the real estate market, actually. That market has matured. I think we'll hear a bit more about that in the future. Final point on the debt side, I mentioned it before, we're seeing greater levels of equity in transactions, but certainly what we are also seeing is elevated leverage levels. There's more increased usage of senior debt and traditionally on the mezzanine side as well, which is significant. On the debt side as well, what we're seeing is what I classify as sectorial drift. Those were deals that were done probably 2, 3, 4 years ago as LBO and now being done as infrastructure. What does that mean? Higher leverage, weaker covenants, no amortization. So we're seeing that basically across the board. And then finally, in terms of risk appetite on the debt side, we see a very, very strong appetite from players in the market, both institutions and banks, for underwriting risk. That has emerged, I would say, over the last sort of 24 months. And in addition to that, what we're also seeing is people prepared to underwrite fixed rate tranches as well. So interesting market.
Thank you, Matthew. Before I turn to the equity funds, Philippe, when you hear Matthew saying that there is a lot of appetite from banks, when the lights are off and when we're discussing offline and not on the panel, is that what you hear as well?
There is, yes, indeed, more appetite from banks, but I think that they are somehow still quite protected with cash sweeps. And second, I think that they are still leaving to the sponsor the refinancing risk, which is something that has changed for us, is that we need to factor, to be competitive, to factor upfront a refinancing risk, which is not always easy. Just an example, we did a project in Bahrain, was 9 years ago, and was together. And that country was somewhere in the A range. Today, we have been struggling for 24 months about to refinance it. And we basically, the country is today close to B. So this was really a challenge. And this is probably not the first one we will have, is those refinancing risks are now on the sponsor side. And it's a big challenge over the next years if this happens.
Thank you, Philippe. I would like now to turn to the equity funds, and maybe starting with you, Angelica. Antin has had a quite particular way to address this market. I don't know how I should call it, value-add type of strategies. Can you share, please, with us the way you have been designing your strategies in this market?
Sure. Actually, I have to disappoint you, but we've always been addressing the market in the same way. So it's quite unchanged over the last 10 years. And by that, I mean, we've always played in the what you basically called value-add segment of the market. I liked also the comment from Matthew saying the market has matured. It certainly has. The European infrastructure scene is actually quite young. So if you can give it maybe 15 years, and it has matured over the last 15 years in the sense that today you have different strategies which are pronounced pretty much more clearly than it used to be about 10 or 15 years ago. And in that segment, we've always been extremely cautious about regulatory risk. All core infrastructure is imminently tied to regulatory risk, so that's not an area we've been active in. What we've been doing over the last decade is really to use a private equity toolkit and deploy it within the infrastructure. So we would look at, stable businesses with very high barriers to entry, with very foreseeable cash flows in the future, but very well downside protected. But equally, we would try to make those assets better. We would like to employ additional capital in order to help them grow, and really, by that way, by being able to double or triple EBITDA during our hold period, to help develop these companies, and then obviously also help develop our returns. That does imply quite a unique setup. So we have a very strong team. We get very much involved within our portfolio companies in order to successfully execute such a strategy.
Maybe question to you, Angelica. And in this strategy, how do you set the borderline between what is infrastructure and what is private equity?
Well, I guess that's actually the interesting part about the current market, because some people today seem to be going a little bit off-piste. I like to think that we are not. We have always had a very clear set of rules, actually, which we call the infrastructure test. So we're looking for high barriers to entry, stable and predictable cash flows, downside protection, inflation link. And that is the way we look at infrastructure more generally speaking. So you might argue we're looking at it from a risk perspective and less so from a pure industry verticals perspective. I can show you lots of airports that in our definition wouldn't be infrastructure just because they are very high risk assets, because they're small, or they depend, say, on one client such as Ryanair. Nothing against Ryanair, but dependence on one client tends to be always a bit tricky. So for us, that wouldn't be infrastructure, but obviously in your general thinking, an airport is always a piece of infrastructure because it is an airport.
Thank you, Angelica. Turning to you, Laurent, are you having a similar type of strategy? Is value add something that you're engaged in, or are you more on the core type of strategies?
So I would say it's always difficult to define what is core. I think if you talk to 20 people, you get 20 different definitions. So what we like to say on our side is we like to invest in essential assets, but it should be assets. So if it's like on the edge services and so on, we, as you were mentioning, we like concrete, we like macadam. But what is...
Nothing wrong about that.
Nothing.
That's fine.
However, what is important for us, and that's where I think we are very stringent when we pick up asset, we want to pick up asset that we can grow. And that is very important for us. So it would be a bit more like platform. So it could be airport, it could be a road, it could be a wind farm. But our intention is really to grow that business. And I think that would make the difference maybe with insurer or pension fund, is to say, okay, I do take one asset, and maybe the return is on the low range, but with all what I've done, what we will do with the asset management, growing the assets, we get some example, like for example, Luton. In 4 years, we grow the airport from 9 million pax to 17. So it's huge. It means really that you have to get people on the ground. We're working with a lot of operating partners in each, I would say, sectors. And that's really a plus. So for us, the core thing is essential asset. So we will look a bit less at, let's say, services. And on top is, I mean, asset that we can really grow, and that is very, I would say, important for us.
Angelica, maybe a reaction to that. You've been investing in infrastructure businesses where we could see a lot of services. So, how do you,
it does trigger some interesting questions, like, is a concession an asset or not? Is something that needs authorizations, of which there won't be any new ones, an asset or not? So I think, again, we're taking really a risk approach to this, and an asset that has no value in the future has no value as it is, right? An airport that might move away has no value, even if it has concrete. Even if it has some concrete base. So I think there is an interesting part, obviously. I mean, the infrastructure sector traditionally has assembled people coming really in the early days from real estate, from the debt fund side and from private equity, and you kind of took all the ingredients because it has a little bit of everything. For instance, we recently, 2 years ago, invested into the 15 largest train stations in Italy. So that would include Rome and Milan, and we have the exclusive rights to market the retail parts of these airports, of these train stations. And so in that perspective, you say, right, but it's only a concession. But I mean, it's difficult to argue that the train station of Rome wouldn't be a very beautiful piece of infrastructure.
Back to you, Laurent. Ardian has been on the forefront of the digitalization of infrastructure. Can you share with us your experience in that?
Yes, for sure. That's something we developed, I think, let's say three years ago. And the key question, I think, at that time, we invested in one company called Indigo today, Vinci Park before. And we were just thinking loud, what could digital, and it could be new apps, but it could be new tech, could bring to the company. And I would say, even more importantly, also, what kind of disruption could we get on that asset, or could we push to other players? And from that point, and I think it was very interesting because I think you need to be minded this way, and the main part of the work we are doing today is really to influence our CEOs, because I mean, we can believe in what could digital bring to the companies, but then in the end, it's the management who is really on the day-to-day pushing for those solutions. And we worked a lot. We had some CEOs day. We had some exchange with small companies with new tech solution. Now we are thinking a bit differently. It's really sector per sector. So we worked a lot on airport, for example. On Naples, we completely changed the airport, and on Luton also. So it's like how to drop your bag, how to pass softly the security gate. The main goal anyway is to get people on the duty free. So that's I would say the main rule. But this creates value. And now we're working on roads and energy. Road, for example, and I think it's something that anyway we'll have to do. I think we are owner of 700 kilometers of motorways in Portugal. And we worked a lot with 2 universities in Portugal just to improve asset management, O&M costs, but not only the cost, making sure that we could deliver the O&M and renewal at the right time. So I would say well in advance of any, like what we've seen. So it's terrible, but tragic event in Italy. And for example, on those 700 kilometers, we got something like 10,000 sensors measuring slopes, bridge, walls. So it doesn't mean you can solve any situation. It means it can really bring value. It can also bring value. We get the same kind of tools for renewables, and it's, for example, would be much clever to do all the maintenance work on a wind farm when you don't get any wind. So we get some solution also to measure the wind and to anticipate the wind stream. So just to give you some very small example, but that is something for us that we really believe could create value on top of the essential assets.
Before I turn to Klaus and to give us the debt perspective, Angelica, you mentioned to me also some developments when you are crossing between the sectors, the transportation and energy transition, about the batteries and electric vehicles. Are these business models that you're developing as well?
Yeah, I think if you look at digitalization, obviously today, you just can't ignore it. It's like, like when electricity invented, you couldn't just continue to do candles. So I think the way we look at it, you have on the one hand side, potentially a disruption to something that looked very safe at some point in time. But equally, you have a great chance of improvements. The other thing that's very interesting about this, you suddenly have a convergence between subsectors. So for instance, and that is probably very dear to your heart, you used to look at transport, and transport was transport, and energy was energy. But today we have, electric vehicles, and if we don't have them today, what is pretty sure we're going to have them in 10 years in a very significant amount. And equally, we have the whole issues around renewables and how that impacts the grid, and hence we need storage solutions. But you know, an electric vehicle is nothing else than a battery with 4 wheels, basically, and you could actually basically connect the two, in which, you know, electric vehicles could provide a certain level of storage and intermittency within the system. So you need to think, you need to start thinking across industry in that aspect, and I think the amount of change we're seeing and the speed of it just pushes you very much to do so in a much more advanced manner than we had to 20 years ago.
Thanks a lot. Klaus, you're on the debt side. The debt is always 1 or 2 steps behind these quite exciting developments, but which may start as a pure equity play in the beginning before they become bankable. How do you look at these developments from a lender perspective?
I think, we probably need to take a step back and first think that infrastructure debt is really a new asset class, right? It's the first deals, the first greenfield bonds were structured really 2013, and the big groups really moved into the space. So compared to the equity side, it's a newer product, but clearly has experienced a lot of development in the last 6 years. I think in today's market, any sponsor hopefully will, when he wants to finance this project, think where are the banks, where are the institutional investors, can I potentially combine the two to get the most efficient solution of financing. So clearly a lot has happened. We have a lot of different platforms now in the market and direct investors. And similar to the equity side, clearly there's a lot of liquidity in the market, and it really depends on the platform how to position the platform and try and identify the attractive transactions with the right risk-return profile, which is a challenge in today's market. And I guess we can discuss it also a little later, what kind of alternatives are out there, but it's clearly our main challenge.
So the proposition whereby you're taking more risks in order to deliver more returns to your investors, the drift that has been talked about, is that something that you and more importantly your investors feel comfortable with? Are they the ones pushing you in this direction?
Yeah, I find it dangerous to segment it that way. I think with increasing risk and increasing return, other investors also enter the market. So I would distinguish really what's the motivation of the investor to get into this asset class. And clearly, you mentioned it already, there are life insurance companies who have the long duration liabilities, pension funds, and they really look for stable investment grade core infra, which is really suitable over several years to provide a valuable hedge in their balance sheet. And then if we move, let's say, into riskier, maybe non-investment grade asset classes, and hopefully shorter, we can see other investors coming in and really looking at this, from who don't necessarily need the duration, but they look at the asset class as a private alternative to which provides an additional yield. But clearly, yes, I can see also with our investors that most of them really look more to the yield than necessarily the underlying structure, and they really depend a little bit on us as well to be disciplined in what we are doing, because you cannot expect any pension fund CEO to understand project finance. So yeah, it's not an easy answer.
Matthew, when you see Klaus coming into the market, do you see, well, great, it's a friend, or is it a competitor you have to contain?
No, I think the way we look at working with the institutional investors is very much on a partnership basis. I think if we step back 10 years as to what happened post the financial crisis, what you saw was the monolines disappear, a number of banks also coming out of the market. If you look at the volume of transactions, you saw a number of deals falling over that didn't happen, frankly, which is not a market that we want to be associated with. We're keen to be part of a growing market. I think it's important to see liquidity and long-term capital there, and having new debt investors in the room is important. Important for us. We're a very long-term player in the market, consistent. We're there through the cycle. We've been active in project finance for 30 years. So it's important for us to see a healthy healthy level of competition in the market, which I think is important for governments and corporates as well, to encourage them to bring new deals into the market, which I think is our biggest challenge, actually.
And I mean, I would say, you know, there are situations where clearly we are competitors, but this is true for other banks, right? I mean, you compete with BNP, with Deutsche in the market. But I think with the institutional investor landscape coming into the space, there are more ways to really play to the benefits of each institution. In a sense, we have done a number of transactions where the banks provide the shorter duration debt, and the institutional investor tranches interest only and then amortizes after the banks are out. So I think really it can be beneficial for sponsors to combine the two.
Talking about being beneficial to the sponsors, Philippe, when you hear about you hear Klaus and Matthew competing to get access to your projects, are you a happy man?
No, but I think I would say they are complementary, at least on OECD countries. I think we see institutional investors still okay for OECD countries. When you go to emerging, they are not yet there. So there we are relying only almost on banks or on DFIs or multilaterals such as EIB or the ECAs. That being said, I think that we're still partnering quite a lot with Japanese to get liquidity from JBIC, because we believe as sponsor we are not supported enough by EIB, among others, to play in those markets.
Maybe back to you, Klaus, and the previous sessions did discuss Solvency II and also Basel III. Did you see Solvency II bringing more liquidity to the market from the insurance companies? Is it stimulating the market?
To some extent, yes. I think clearly, especially for senior debt in the infrastructure space, the yields aren't, you know, they're definitely not double digit. And what happened before for a lot of regulated investors, the debt asset class was treated like the equity asset class in the balance sheet of the investor. And that was a big limiting factor. Solvency clearly for insurance companies now opens the possibility for the smaller insurance companies to come into pooled funds. That is clearly beneficial. I think for the large ones it doesn't make a difference who are on the internal model, but it has helped to some extent.
And do you see the prospect of interest rates going up, you know, potentially tempering the enthusiasm of these investors?
I think it's an interesting question. I don't necessarily think for insurance companies it will make a difference. I think this asset class clearly has developed through the, let's say, monetary easing of the central banks, and otherwise we probably wouldn't have seen a development in that scale. But insurance companies also will compete to some extent against each other, so there will always be an element of alternatives in their balance sheets. Pension funds, it really depends on the country and the kind of regulatory environment. I could see some pension funds, once sovereign yields are above 4 or 5%, that they are less keen on illiquid alternatives.
And Matthew, we've heard a bit earlier on about Basel III and the recent developments, and what I heard was not completely reassuring, but I see you smiling and enthusiastic. So what's the trick there?
Sorry, René, it's my most enthusiastic topic about Basel IV. I'm sure the audience will can all probably wake up from the graveyard slot. So Basel IV, how do I categorize it quickly? Because how do I categorize it? The good, the bad, and the ugly, probably. What's the good thing about Basel IV? The good thing is we now know what the potential impact of that is. So from a bank standpoint, you can plan around that. What's the bad? The bad is it's going to be costly to the banks in terms of additional capital, and that's going to feed through ultimately into the cost of financing. What's the ugly? The ugly is I suspect the regulators probably will continue to chip away at it and may well come back for another bite of the cherry. But importantly, for Basel IV, it's not, from the bank standpoint, it's not terminal in terms of providing financing for structured finance or specialized lending, whichever way you want to categorize it.
Thank you, Matthew.
Could I say one word? I think today we see a lot of cash in the market, so equity and debt. I think on our side, there's something, I think I'm listening to you guys, but which is a bit weird. For example, we're trying to refinance Tour Bordeaux. So there's a lot of cash, but when we say, okay, guys, could you come with us 40, 45 years? A bit tough. I'm not speaking about banks, but I'm speaking about it's just like what we're looking for, and I think it's a general comment, is more for, let's say, flexibility to say, okay, at Ardian, we are not pushing for leverage, because interestingly, we like yield also. And the more you push the debt, the less you get of yield for your LPs. So, but what is very interesting for us to say, okay, I got one asset, and for this specific asset, that's the kind of debt I need. I won't push the leverage. I'll be a strong BBB or even BBB plus if you like, guys. But it's like, could I get some duration? Could I get some flexibility? I.e., I don't want a basket for investment, divestment, or whatever. It's much more like, okay, could we have, let's say, an open discussion, and could we try to build the tranches of debt that are, I mean, expecting for this very specific asset, and sometimes hopefully we finding agreement, but it's not easy. Like again, like you take the bond, people will push you to 6, 7 years, cash sweep, year 6. Or, why? Again, if the matter is really look at cash flows, do you need your again cash sweep in year 6? I don't know. Maybe the answer would be yes, and again we'll accept that request. Is just like, I think we need some time to think a bit differently, to say, okay, guys, that's the cash flow I got. What can we build on that kind of let's say product? So sometimes it's short term, sometimes it's long term, but again, try to think a bit differently.
Klaus and Matthew, is that your experience in real life when dealing with Laurent? Is ready to pay for flexibility?
Maybe I'll comment first. Is he prepared to pay for flexibility? It's an interesting question, whether sponsors are prepared to pay anything in this market. Look, I think let's take it from the viewpoint of the banks. The bank model is one. I mean, look, from a long-term financing perspective, banks are capable of providing long-term finance, but I think it's few and far between in terms of the type of project they will do. It needs to be top-quality sponsors, investment grade, with a story still to rotate in the future. You take SEA Tour Bordeaux, I think that still exists on that particular transaction. But other than that, the banks are not there to provide long-term 30, 40, 50-year money. It's just not what we can do. We talked a bit about regulation earlier. We don't have the capital to do that. I'll turn that back to Klaus in a moment to say that. But from a bank standpoint, it's about providing different sort of services to the sponsors. So certainly on something like a large rail project which has construction financing, which is complex, there will be a natural migration of the rating from when you're building it through the construction period to the operating phase. There may be some ramp-up concerns around that. It may take a little bit longer. So having a natural refinancing point at 6, 7, 8 years makes sense, I think, from a sponsor standpoint. We know at that point you're going to raise much more significant sums from the market because the banks will come into play at that point.
Sorry to stop. I heard Philippe quite cautious about refinancing risk. He doesn't seem to like it.
Indeed, the key challenge, and as part of my function, we have financial advisory. It's what are your assumptions you take for refinancing at the time your investment, where you need to target a certain return for your shareholders. And that's the key question I have in many projects with my colleagues, is what are those refinancing assumptions? And it's a key risk that lies with the sponsor.
Thank you. Klaus, are you...
Sorry, can I comment on
that? Yeah, please, quickly.
Sorry, because I do see it's an important point there. I don't necessarily see that risk sitting with the sponsors. In some of the PPP models around the world, you look at Australia, for example, that's a classic market at the moment. That probably has, hands down, the biggest PPP pipeline globally in terms of transaction volume. And there, and it's all short-term 6 to 8 year bank debt that's rotated into the institutional US private Euro public market. There you've got the government doing a sensible risk sharing around interest rates. So it doesn't sit with the sponsors there. So I think there's an interesting dynamic with the grantors to have around that particular point.
Quick word, Klaus. We're talking about 40 and 50 year money. We have only 10 minutes left. So.
No, just on the refinancing, I think, obviously the lower the leverage, the more refinancing risk can you accept in a structure, and it really depends how much leverage the sponsor wants to drive. I think, to your point, I think both sides, obviously, and this is the beauty of the asset class, you need to be flexible, you need to find a solution, the most efficient solution for an asset class. And every investor group, banks, institutional investors, depending how you're looking at, have certain, let's say, requirements they do need in their investments. And in our book, on the core side, the weighted average life is 19 years. The longest financing we've done is 40 years. If we do that, and we really want to use this for the asset liability hedge of the life insurers, and for us, for instance, to give you an example, is that we can basically be sure the debt will stay in the balance sheet to the end, or at least you get a compensation if you get refinanced at lower interest rates. So, within those parameters, yes, we can be flexible. There are certain aspects which are very difficult.
Thank you. I would like now to discuss with you responsible investment and ESG, and maybe if you can share with us comments on how important this is becoming in your investment strategies. Is it really a key driver? Is it something that you really think about when you're designing your strategies?
Yeah, I think, obviously ESG now and impact investing is such an important aspect of our world. I think naturally infrastructure is beneficial to impact and ESG, but clearly I think in our due diligence and in our underwriting, it is an important factor, which hasn't been there 2 years ago. And I remember, I think it was two and a half years ago when we actually wanted to be brought a credit to approval, and unfortunately AXA 1 week before decided that they're not financing coal any longer, and Allianz decided to follow suit. So that was really the start where for us it became an important factor, and we have to follow that policy.
Angelica, are you ESG driven?
I wouldn't say we're ESG driven in that sense, but it's something we've always taken very closely into consideration, and it's always been very dear to our heart. So we've always actually had an ESG reporting. I remember we won a prize already in 2010 on our ESG reporting to our investors. So it's something we, as a standard, really look into when we do a new investment, how it sits in those criteria. What is true, though, I would say, is the attention of our own LPs has increased very significantly over the period, and indeed some of the big institutional banks have taken very strategic decisions when it comes to investing into, I guess, financing coal assets and similar. So it's become, I think it's a topic that's on top of everybody's agenda today.
And do you guys see a tension between your fiduciary responsibilities vis-à-vis your investors, which is about delivering returns, and the ESG approach? Maybe Laurent, comment on that.
So first of all, I think for us ESG is a key criteria already at the time of the investment. So we get a checklist, and if we're not compliant with those rules, then we may not invest. So this is, I think, very, very important for us. It's even more important that day one also we define a plan how to increase and I would say optimize the asset on the ESG side. We're working, for example, with KPMG, and every year it is a measurement. So it's not like, is it good, is it bad, is it like, do you reach the KPI? Yes, no. If no, then you need to improve. And that is, I would say, very, very important for us. The key point also is, because we are really on a daily basis also on that, is to discover, and that was my case, to discover that ESG is not only environment, and you can do a lot on governance, you can do a lot on social. For example, I think recently on Calista, we've made a financing of a wind farm with all the employees of the company, and they were asking for that, so I think it's very interesting. We exited 2 recently, Enovos and Calista, and I think there was a reward plan for all the employees, so not only, I would say, key managers, but all the employees. So this is for us something which is very important. I would say also on the way you are, in a way, selling your assets. Just thinking loud about, for example, what we've done on Luton Airport, working with the council, getting school on the airport, and then when you have to negotiate something with those people, they do hear what you're saying. Same on say wind farm. We had some public day. People went to visit the wind farm, to go up and up the mast, and the key point was, anytime then when you are requesting for a permit, people understand what you mean, people understand what it means, really, and it helps developing your business plan. So I would say, strangely, it's a lot of time to be spent on it, but it creates also value, and that is something, at least for me, I was not really, convinced at the very beginning. Today, again, like on wind farm, on airports, it creates value.
Any additional comments on that? Well, maybe before, well, we have 2 minutes left, well, less than 2 minutes left, so I suggest we wrap up this discussion, and I would like now to ask each of you to pick up just one opportunity, so it's on the positive side, and one challenge you're seeing in the markets for the years to come. Maybe Philippe.
I think the opportunity for us will be, we are very much investing in energy transition. I think the biggest challenge will be the granularity of the projects and the number of projects that you will need to build to come to a sizable amount to have banks or insurance company or even funds investing into them.
Matthew?
Biggest opportunity for me, if the market gets going, is what happens in the US, actually, in terms of geographic opportunity, because it's huge. And in terms of challenge, what do I see the greatest challenge? I think greatest challenge for Europe right now is we need new additional greenfield opportunities, and the biggest challenge is I continue to structure and work on deals that I've continued to work on over the last 10 years. So we're buying and selling the same assets over and over again. That's not a healthy market.
I think for the asset class as a whole, the biggest risk and the biggest opportunities is everything that's around the digital developments.
Yeah, I think the opportunities for us are clearly regionally broadening our remit out of Europe and the US, and there are clearly some good opportunities, and clearly also in the type of assets we are looking at, which are more like on the crossover space.
On the opportunity side, I think we'll see more and more privatization, and looking at France, I think we're missing greenfield for sure. But looking at the Loi Pact, for example, there will be opportunity on that side, and I think will spread over other countries in Europe. On the cons, I would say really to create value again and again. I think would be quite tough to select the right asset, to be very stringent on our selection. The key point for us is, if you look at the way we're doing our business, is really 2/3 is linked with industrial. So it's not like moving to one asset and one tender to another. Is really like pursuing the strong relationship we get with key players. So that we expect this could continue. And maybe if I can add one thing.
One last thing.
Because I need to make some add. We are having a seminar on, I think, all what we're doing with Faber-Noël on digital and how it can create value. And it's at Élysée Biarritz Hotel on Thursday morning. So if some of you are interested, they are more than welcome. Thanks.
Thank you. So thanks to all of you. I think we're running out of time, so we may not have time for questions. So please join me in thanking the panel.
René, thanks very much. And thank you to the panelists for a thought-provoking and stimulating